Alphabet, better known as Google, is the fourth most valuable company in the world with a market cap of $2.071 trillion. Google has an iconic brand and an incredibly wide economic moat in search. On top of this, they have a fast-growing business in cloud, which is now the number 3 competitor behind AWS and Azure. Google's wildly impressive business model has led to great returns for investors. And with $100 billion in cash on hand, the company just declared its first dividend payment ever. The Google dividend is expected to be a quarterly payer, and at the current declared amount is a 0.48% dividend yield. While that starting yield is small, there is no question that Google has the capacity for high dividend growth well into the future. Despite this, Google stock is down 9% over the past month. Since reporting earnings at market close July 23rd, the company has seen its stock price fall over 9%. So today I'm going to ask the question, is now the time to buy Google stock? To figure that out, I'm going to dive into the latest Q2 earnings report and then do a full stock analysis on Google stock. That will include future analyst growth estimates, price targets, and a buy rating. If you stick around to the end, I'll share my personal thoughts on Google stock and whether or not it will be a part of my portfolio over the long term. And this recent decline in Google stock price is actually getting worse, as at 2 p.m. today, OpenAI announced a new product aimed to compete directly with Google search. As a result, Google stock fell 3% after the news. So I will also jump into this Search GPT news and explain whether I think it will impact Google stock long term. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Alphabet, ticker symbol GOOGL, is currently priced at $167.28 per share. Over the trailing 12 months, earnings per share was $6.97, giving it a 24 P ratio at current prices. The forward-looking annual dividend is 80 cents per share, or a 0.48% dividend yield. Since the tech recession of fall 2022, earnings per share for Google and many big tech companies have surged back up to all-time highs. And the historic financials around Google stock are incredibly impressive. Over the past 10 years, the compound annual growth rate of revenue per share is 18.41%. In that same time, net income per share has grown at a 19.66% 10-year CAGR. Free cash flow per share has grown at a 20.55% 10-year CAGR. This has actually accelerated over the past 5 years at a 5-year CAGR of 27.35%. The Google balance sheet is ridiculously impressive, as their business just prints money and they rarely need to use debt, if any. The company has negative $72 billion net debt, meaning they are incredibly cash rich, as they always have over $100 billion in cash and short-term investments. In fiscal 2023, they generated $69.5 billion in annual free cash flow, and they use this money to buy back stock at a massive rate. For example, last year they reduced their shares outstanding by 3.32%, and in 2022 by 2.91%. On top of share repurchases, they have just started paying out dividends as well, which amounted to $2.47 billion in the last quarter. And as I mentioned earlier, hopefully this is a trend of dividend growth over the long term. However, all is not perfect for Google stock. For example, I will address some of the concerns found in the latest earnings report, such as very high capital expenditures. But really, the future for Google stock will depend on how high future growth is for the company. So after analyzing Q3 earnings, I will come back, look at future earnings estimates, give my thoughts on a price target for Google stock, and analyze the competition of AI and how it could disrupt their Google search monopoly. And by the way, if you want to use all of the tools I've been using throughout this video, then sign up at dividenddata.com. I created this research tool with everything I need to analyze a stock to help you find better investments. So sign up at dividenddata.com. Okay, so here are the second quarter 2024 results for Alphabet. Revenues for the quarter came in at $84.7 billion, which is a 14% increase year over year. Operating income for the quarter came at $27.4 billion, which is a 32% operating margin. So compared to 2023, revenue growth has accelerated, nearly doubling, and operating margin expanded from 29% to 32%. 32%. Overall, net income came in at $23.61 billion, and diluted earnings per share for the quarter was $1.89. That is a 31% increase year over year. So this is incredibly good year over year growth for Google. And if we break this up by product segment, you can see that Google Services grew from $66.2 billion to $73.9 billion. Core product here is Google Advertising at $58.1 billion to $64.6 billion. Google Search is the dominant part of that pie at $42.6 billion, growing to $48.5 billion. And YouTube ads at $7.6 billion grew to $8.6 billion. However, the Google network actually declined slightly in revenue. And I believe that would be display ads that could show up on someone's blog if they have ads enabled. But long term with Google Advertising, I almost entirely put this on Google Search and YouTube ads, as I think those will continue to grow well into the future. Google Network is definitely their weakest part of their advertising business. The other notable business segment here is Google Cloud, which grew from $8 billion to $10.3 billion in revenue in 2024. That is a 28.8% year over year increase. And when we get to the operating results for each segment, it becomes painfully obvious that Google really at this point is an advertising business. Operating income from Google Services grew from $23.45 billion in 2023 to $29.67 billion in 2024. And that is a 26.5% increase year over year. And it really puts into scale how large that business is relative to Google Cloud. Google Cloud operating income was finally positive in 2023 at $395 million. And that has now grown in 2024 to $1.17 billion. So yes, this has the opportunity, 5-10 years from now to maybe be a $5 billion business for Google, but that will still be dwarfed by their advertising business overall. And again, to put that in context, the year over year growth of Google Services operating income was over 5 times the total amount of operating income from Google Cloud. So these really are two different scales of businesses right now, and you can put most of the valuation, in my opinion, onto the Google advertising business. All right, so what are the negatives I found in this earnings report? Well, YouTube ads revenue for the quarter of $8.6 billion came in 3% what analysts were expecting. So that was the main miss on this quarter. Now, long term, I don't think that's really an important detail at all, as I think YouTube is primed to grow massively over the next decade, as it will become pretty much the dominant media platform that exists. It simply just has a massive user base and it's free advertising based solution. I also think people do gravitate more towards authentic content from content creators like myself, for example. The other major negative I saw here was that capital expenditures grew to $13.19 billion on the quarter. And this CapEx has doubled over the past year as they're spending massive amounts of money on NVIDIA GPUs, specifically the H100s for AI training. And that is both used to give the supply to Google Cloud to support other customers, but also used for internal Google projects, such as their own AI model and various models they run to improve their advertising business internally. These could be things like recommendation algorithms, etc. And while as an investor over the short term, this kind of hurts to see this kind of spending, as I'm more in the camp that companies are overspending at this time. However, I also agree with Google CEO Sundar Pichai when he recently said on the earnings call that there is far greater risk in underspending on AI at this time. They do not want to be caught in a situation where they are caught empty-handed compared to their competitors. And this game of business is not all short-term financials. At times, you need to invest just to make sure you maintain your competitive advantages in the market. And that is what they are doing. In fact, they would be stupid if they did not do that. Speaking of competition, let's talk about that OpenAI news. They just put out a waitlist so that you can try out Search GPT, which is a prototype of a search engine with AI integrated throughout it. And it's important to mention that this is not an entirely separate project. They are planning to integrate this into ChatGPT in the future. They are focused on giving you the answer right away. So it's almost more of an answer engine than a search engine. And from a technology standpoint, I love that they're competing in this space and putting some pressure on Google. However, I don't think they will actually take significant market share away from Google. In fact, I've been seeing Google integrate all of these AI features into Google. And I think that's a far more likely outcome, in that AI will just become intertwined and accelerate their current business model and advantages. ChatGPT has been able to get massive distribution, but distribution is the hardest part. Google already has 90% market share in search. Google has become a verb. And in the tech community, they've been saying that Google is dying for a while because of these AI tools, but I think it's just incredibly overstated at this point, like dramatically overstated. So I actually think Google Google will maintain its economic moat in the search market. In fact, I think it will continue to grow from here. Analysts are projecting double-digit growth of earnings per share through 2028. By the end of fiscal 2024, they're expecting $7.04 earnings per share, with a 23.7p ratio. In 2025, they're expecting 23.12% growth, 2026, 14.93% growth, 27, 18.56% growth, 28, 21.87% growth. That makes it an estimated earnings per share of $14.39 in 2028. At the current stock price of Google, that would be an 11.63p ratio. That would be ridiculously cheap for a high-growth, wide-moat company like Google. Do I think these growth rates are accurate? Roughly, yeah. It may not be as pretty or consistent as this, but I do think long-term it's going that direction. And that doesn't mean there couldn't be a year like 2022 where we see decline, but then growth just races back up to all-time highs. And currently, analysts have a price target of $167.17. So using these price targets, Google is trading at fair value. And I would actually tend to agree with that. Google is a wonderful business trading at a fair valuation. Among analysts, the consensus rating is a buy, with 35 saying buy, 1 saying strong buy, and 4 saying hold. So what do I think about Google stock, and will I be adding it to my portfolio? Well, I certainly have it on my watch list, and I likely will add to it sometime if there is a great buying opportunity. And I think you will be poised for pretty great returns. For example, if they hit this 2028 estimate of $14.39 in earnings per share, and you just applied a 25p ratio on that, which is incredibly reasonable, and it's what it's trading at right now with a relatively low multiple historically, that would give Google stock a price of $359.75. That means the stock price would more than double by then, and I think that's an entirely reasonable estimate. But all of this is just my opinion, so be sure to do your own research before making any investing decisions. Thank you for watching, and if you want to use the tool I've been using throughout the video, then sign up at dividenddata.com. I created this research tool to help you find better investments. Thanks for watching.